Hello, 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 everyone. Happy Thursday afternoon. How is everyone doing? Good afternoon, Patrick. George is on top of the world. We got Gary here and Josh. Good afternoon. Salesforce got crushed following earnings yesterday, but PE still at 275. Oh, let's not talk about insanity in the markets. Everything is just hunky dory. Don't you know that? VIX back under 20. So we'll get Bob's take on everything and the world in 1 second. We had ISM in contraction. We had S&P PMI in contraction. We'll get Bob's. Well, we'll just, you know what? Just subscribe to this channel because I'm going to bring Bob on. There you go. With that, here you go. Here's what everybody's been coming to see. The blue shirt, Bob.
What's up, guys?
How you doing, Bob?
Doing good.
Do you know everything's fine in the world?
Yeah.
The
Yeah, seems
markets, the market's undervalued. It's a guaranteed bull again.
seems good again, Mike.
Guaranteed. The no-brainer trade is guaranteed through the end of the year. No brainer. So
Well, I sort of agree with that,
when it's a
but
no-brainer, though,
it's
you
never
know,
a no-brainer. It's never a sure thing. Yeah,
yeah. Rich is all in short.
Rich is all in short. That's probably not going to work out that great, but
Uh, hey, Gary says, "Hey, big dog, Bob. Big dog. What do you got in your hand, Bob?
Apple.
An apple.
Mm-hmm.
Bob, a man of the people.
Why could I mean an apple?
I don't know why, but maybe you're just more a man of the Smurfs with that shirt.
What'd you call it? Man of the what?
Smurfs. You look like Smurf Blue.
I feel like a Smurf sometimes, Mikey.
There's a problem though. There's only one Smurfette. What are you gonna do with this, huh? The competition for one Smurfette was been off the chains. We went from cars to Smurfs. Last time it was cars. Now we're talking Smurfs. What's coming up next? Gary's short and long all the time. There's a joke in there too. But
There it is. I know what the joke is. You've done it before.
let's get straight to the numbers before anything. Before even we got a slight pause, pullback in the markets today.
Yeah.
No fear anywhere. We got the PCE numbers coming out. I would need your take on PCE, on jobless claims, on anything Fed said, on manufacturing PMIs and everything, and then preview for non-farm payrolls. That's what I need from you. Just lay it on us.
So, oh, sorry. Um, Sorry, I got to respond to something really quick. Look, one of the things I noticed in talking to somebody else about this was that it's still only an 81% chance of a 50 basis point rate hike as opposed to a 75. Now, that's gone up during the course of today, but you realize that like on November 23rd, it was a 75% chance. So this isn't that big of a change. You know what I mean? It's really not. So the market's reacting the way they did. I actually completely understand the little bit of a sell-off today because yesterday's market reaction, I believe, was a dramatic overreaction. Given that things are not that much different than they were a couple days ago, from at least from a market perspective. Now, the yield follow through that we got, I think, is a bit dramatic. I mean, we've got the 10-year at 351 now, right?
The yield, the 10-year, and boy, everybody who said this trade will never work out with the double bottom in the 10-year. Oh, well.
Yeah,
Yeah.
I mean, if you just go back to the 21st, okay, just November 21st, all right, we were 383.
Yeah,
So we had a
now we're
32 basis point drop in just what is basically 10 calendar days, but
yep,
only 1, 2, 3, 4, 5, 6, 7 sessions where markets were open. You move 32 basis points. So yields are again pricing in. So here's what's funny, they're pricing in Fed cuts. So we believe the Fed when they say they're going to step back the pace of rate hikes, right? We believe that. But when they say they will not reverse course quickly, we don't believe that because the market's already pricing in what? About 75 to 100 basis points of cuts by next year.
yep,
Now, I was talking to Mike about this a little bit earlier. I was looking up how many CEOs we have that are under 40. So, why did I pick under 40? Well, the last time the Fed funds rate was anywhere near where people think the Fed are, people including myself, think the Fed are going to bring it was 2006 when rates were at about 525, right? The Fed fund, now I'm talking about the Fed funds rate here, right? So that would have been what, 16 years ago? So if you have a 37-year-old CEO like Mark Zuckerberg, he was 20 or 21 at the time. He certainly wasn't CEO, right? So if you're looking at anyone in their 40s, early 40s, late 30s, there's a lot more CEOs than you think that have never seen money cost anything. They've basically just seen free money. The high Fed funds rate during the last, again, let's call it 16 years, from 2016, I'm sorry, from 2006 to 2008, we went from 525 to zero, right? So you've now got this list of Fortune 500 CEOs that have never seen money cost anything. Where those of us that are older than that know that money costs a certain interest rate. It's not free. We had Amazon do their second bond offering, and the 10-year duration bond offering, and I don't know how old Jeff Bezos is. I think he's older than that. I think he's in his 50s. But their richest bond offering in the last release that they did is going to pay 1.5% over treasuries. So it's a floating rate offering. So Amazon could be servicing debt that's, I mean, let's just take today, 350, that's 5%. If inflation doesn't calm and the 10-year goes back to 4.5%, talking about 6% debt on Amazon's books, how many CEOs know how to handle that? How many CEOs have any experience handling it? None of the young ones. You're talking about Coinbase has a young CEO. These guys have had free money and very aggressive public markets that just buy their stock, right? They just buy it. Those people haven't experienced this. And it's going to be interesting to see how they manage an environment where money costs. Now, here's the second thing. When you're pricing in rate cuts, you're pricing in a slower economy and inflation down, let's be generous and say 3.5%. Because otherwise, why would the Fed cut rates? If growth is strong and inflation is strong, why would they cut rates? If growth is slow, but inflation is still strong, would they cut rates to spark inflation again? Probably not. They may stop hiking, but they're not going to cut. So if you're looking at a Fed that's going to cut rates, you're looking at slow growth and low inflation. That means, in my opinion, an unemployment rate at 6% or higher. So to the data, core PCE was lower than expected month over month, right? 0.2 versus 0.3. But what was it? Up or down?
Up.
It was up. Prices are rising still, according to the Fed's favorite metric. Prices are still rising. The month over month the year over year headline, 6%. The year over year core, 5%, as forecast, down from 5.2, still 3 full percentage points away from the Fed's target. So they have one of two options: keep rates high or put a new projection out. We now think that 3.5% is sustainable on inflation, or 2.5 or 4. And if they do that, do you think stocks will do better or worse? They're going to do worse. So I'll leave you with this, and I'm not really leaving you guys. You can ask questions if you want or whatever. With the PMIs and the ISMs being in contraction territory, we also had the ISM, right? All the ISM figures were in contraction territory. I didn't see one above 50. Am I wrong, Mike?
Nope. Everything's in contraction.
Everything's in contraction territory. So there's your slow growth part. Inflation's still rising. Not rising as fast as predicted and not rising as fast as it was. But what's it doing? We can all say it at once. Not you, Mike. You can all say it at home. It's rising. Prices are still going up in aggregate. Okay, don't ignore this stuff. So does that mean I want to get out of my fourth quarter longs? No, because I don't believe many market participants believe that because they're pricing in cuts. So I'm leaving my S&P longs on, but I said it on a TV interview today. I don't remember who it was. It might have been TD Ameritrade. No, it wasn't TD Ameritrade. I don't know, not important. My crude oil short, or the short call, I'm not actually physically short crude oil, the short call, where I said $65 before 105. The closer we get to the $65 level, the more I hate it. I hate being shorted because we get closer and closer. And I think the next shock move in crude oil is up because I don't think OPEC likes this and I don't think Russia likes this. But in terms of the equities, there is nothing telling me that the first quarter of next year and the second quarter of next year are going to continue the fourth quarter rally. That's it. That's all I got for you, Mikey.
Hey, Bob. Coco wants to know what's your target on the S&P 500.
End of the fourth quarter. Don't have a target. We've said that before.
You don't have a target?
Nope.
Well, it's also dependent on your time frame. I mean, you could have, because my target's a lot lower for next year.
Mm-hmm.
It's not higher than where it is now for next year, but we could keep the probability say we could keep going for some more this year.
I mean, if you force me, oh my God, hold on a second. I gotta hit the mute. Hold on, cough button.
Well, Bob is coughing. I'm just going through the questions. You back, Bob?
Yeah, I'm back. I just got to turn this back on.
All right. Here we got a question.
If I had to give you a target, if I had to give you a price target, it'd be around 41.50.
For this year or next year?
For this year.
All right. I was
No. I've said this before. I'm long for the fourth quarter. I think the first quarter and second quarter are going to be awful. If I had to give you a target for first quarter, second quarter, I'd say 31.50.
All right. That was making more sense to me for first and second quarter because, I mean, we're now priced back to it wasn't as lofty as before the sell-off began, but the PE, the earnings still projections are quite lofty, and the PE multiples back to pretty lofty. The market's priced for perfection now, in my view. Like, there's going to be hey, the soft landing's just baked in. We might as well take rates. But if the soft landing's baked in, why would you have to lower rates at all?
Exactly. I can't find any reason to lower rates, but the market's pricing it in. Before we
So
go to the questions, I want to know why Coco thinks I'm lying. How is anything I just said any different from things I've been saying over the last month and a half? Mike, did I say anything inconsistent?
not that I remember.
Coco says does make sense. Or he says, I think he probably meant doesn't make sense. So because Coco is so over the top good at this stuff, my 3/4 view doesn't make sense to him, so it must be a lie. I guess that's what we're going for.
All right.
All right, we can go to questions.
Panveet, Bob, I don't understand why keeping higher rates for long is dovish.
It's
Does only front loading considered as hawkish?
That's basically the gist of what I'm saying, Pavneet, is people are acting as if this was dovish, right? I said 41.50 Coco. If it hits there, I'll get out. Otherwise, I'll get out at the end of the fourth quarter. That's the plan. Okay, back to the actual real question that makes sense to me. Pavneet, it actually isn't dovish. It's less hawkish. Markets get primed for things. Okay, similar to like when you prime a wall before you paint it. The market has been primed for some time to move higher. And it takes any little piece of information when it's primed to move higher and tries to make that the reason to move higher. And that's why over a couple of days, you see what the actual news event means, right? Now, less hawkish is a reason to be off the lows. But then when you have the issue of what this could mean down the road that people haven't kind of calculated out yet, that's when it becomes bearish, in my opinion.
Also, we still have quantitative tightening going on. I mean,
Yeah.
hey, the signals and the trade signals showed, it reversed back in October to longs, and some of these key targets have been hit, which is fine, and it can easily keep going because we've closed above some key levels. However, just looking at things from the number, not just a technical perspective, but the fundamental perspective, the rally's sort of getting priced to perfection.
Yep.
So, Bob, what is going to make earnings affect the market different in Q1 2023 versus stocks rallying at every single earnings this year?
Well, I mean, we didn't have a very good year in the equity market, so I'm not sure what you're referring to. If you're talking about short-term rallies, I mean, sure, I don't really care about that, right? I mean, you say the market rallied on every earnings this year, but yet how much are we down on the year?
I mean, we're still down.
Let's go S&P.
I mean, I just go look at the year. Where's my? Oh, I guess I could do a 12. That's not going to give me the exact number.
I can do it real quick. Hold on a second. Give me 1 second. It is good to talk about how much we're up or down on the year. We should probably sometimes lead with that, but let's see. Here's April. There's December. So if markets rallied after every earnings this year and you don't believe we could be down next year, then why, as of today, are we still down 14% this year? I think I'm right on that. Yeah. The close of the month of December of 2021 was approximately 47.50. So you say that we rallied at every earnings this year, right? But yet we're down 14%. So why is it not possible? And I'm not really answering your question. I will in a second. But why is it not possible that earnings weren't enough? Now, to answer your exact question, right? Earnings have not come down. Earnings estimates have not come down enough yet. So what companies do, Georgie Porgy, that was Georgie Porgy, right, Mike?
Yes, correct.
Okay, what companies do is they issue lowered earnings. They issued a lowered bar, okay? And then they jump over that lowered bar. Currently, the bar of estimates from corporations is too high for them to jump over, in my opinion. So they're going to lower estimates, in my opinion. And when they do that, stocks are going to fall again. And my guess is they start lowering them next year, because the first quarter of this year, they'll be talking about the earnings for the fourth quarter, right? And some of those may be good. Some of those may be bad. I suspect a few of them will be bad. But then you have in the second quarter earnings for the first quarter, which are also likely to be bad. So they're going to be lowering earning estimates. Right now, in my opinion, those earnings estimates are not low enough. So they'll lower them first. Then they'll jump over that and they'll get little rallies, but it's going to be after a dip. So again, you talk about, I'm talking about quarters here. I'm not talking about the day of earnings or a week after earnings. I'm talking about quarters. And I said the fourth quarter would be up. That's why I got long. And Coco said, why is my target always 41.50? Because we haven't reached it yet, you knucklehead. Why wouldn't my target stay the same? Knucklehead. Anyway, so that's why it can be different. Because again, a lot of these CEOs haven't realized the cost of money has to go into earnings. So they have strong revenue and shrinking margins. So if margins shrink and they don't have pricing power because of inflation, what happens to EPS? It needs to come down. So if revenues fall, the margins shrink even more. That's what I think is going to happen.
Ted asks, so with the VIX under 20, now is the time to go grab June puts or wait?
I think the VIX is broken. I really do. I mean, again, and Mike, you know this better than I do. The VIX is a reflection of what's going on in options. If the options aren't being traded actively and are not moving, the VIX doesn't move. So,
well, the dynamics have now changed because of the massive short-term options turnover right now. Mm-hmm. I mean, it has affected the VIX. I mean, even in the last year, it's affected the VIX a fair amount because the time frame is the duration of, besides your big dealers hedging, doing the portfolio hedging and everything else, the average duration from a lot of the options on the financial futures has gone in. It's 3 days or something, 2 to 3 days. So, and then you have your volatility decay and everything else. I mean, it's just nuts. I think once there's a time to get put into a longer term play at lower volatility. I think volatility, unless there's some earth-shattering event that's completely out of the blue, we should remain at lower volatility. I would rather personally wait for a good topping pattern that's triggered or reversal. Again, I don't just have to call a top. This thing could continue to rally. So I like to wait for a some kind of signal because, I'm not trying to grab the absolute low in the VIX because the low this week could be lower in 2 weeks. I need to it's just like, do I want to sit for another month and just burn? It's not going to be that much theta burn, but there's going to be theta burn and potentially vega burn. Because if volatility continues to trend lower, I mean, we're coming back down to the area of the August lows. They could technically, if this market rally continues, we could go through those and retest the lows from March. So
Hmm.
you could be seeing an 18 handle in the VIX theoretically.
Yep.
Uh, Bob, you already answered that. You're not long oil right now.
No, I'm not.
Let's see. When will we finally see a breakdown in the market with the VIX blasting off?
I don't
Like,
know.
it,
Next year?
it, well, unless there's some unexpected event, which can always happen. Could be next year. Could be. I mean, my first warning sign would be at this point the break back above, at least a break back above 2250. And this ties into even the question earlier. Let's say that this VIX broke a back above 2250, and we're watching the dynamics of a market. It looks like something's breaking, whether that be next year or this year or something else. Uh, I'm That's still not expensive for putting on volatility positions given the recent history of stuff.
Yeah, the
Uh,
volatility, the VIX puts and the VIX it worries me a little because it hasn't worked lately. Coco says I broke the VIX, and that's why I love Coco. That's a great comment. What were you looking
Bob, I read somewhere that the truly to truly beat inflation, Fed fund rate has to be greater than inflation rate because that's why people will be motivated to save. But the terminal
so
rate seems to be less than inflation.
yeah, so that's the Taylor rule, Pavneet. That's John Taylor, who's a economics professor at Stanford, created that 20 years ago. It's part of the Taylor rule. And it's a pretty simple equation. Like you said, savers will be encouraged to save, and their savings will not um, get eaten up by inflation. And in some cases, right now, Pavni, you actually have savers that can beat inflation, not with the recent drop in rates, but there were some CDs and stuff, some longer duration stuff, some corporate bonds that had yields higher than inflation. But yes, that is a theory. Okay, it's I'm not going to say it's been proven or disproven because I don't know, but that's called the Taylor rule, and it's very active. And um, James Bullard is a Fed governor who believes in the Taylor rule, so that's why he's been very aggressive at saying the Fed still needs to get rates higher.
Can't we just replace the Fed with the Taylor rule?
We should really. I mean, it should
I
just
mean,
be
and then
automatic.
it wouldn't it just take hey, would it just take the what are they going to do next out of the equation because you feed the inputs in the Taylor rule and it tells you where the rate should be?
Look, think about this from an inflation standpoint. Next year, everybody who gets Social Security gets an 8 point something percent raise into a slowing economy where prices are falling, prices of goods are falling. You tell me they're not going to spend that money and drive prices back up? I mean, it's not enough to say that it's going to drive a second round of inflation. But if subsequently, or I should say, in correlation with that, if jobs don't come off and wages don't fall, there's a driver of more goods-driven inflation right there.
Sterling, was there this much hopium in the markets in 2000, 2008, or is this a new phenomenon with so many retail diamond handed holders?
This is a great question. So there was that much hopium in housing in 2008. Sterling, you were around. You remember all the house flippers you knew that you couldn't understand how they could be house flippers because they were idiots? So you were around and remember that. This equity diamond hands things was in the tech sector in 2000.
Yep, that's
That's
what I
why
was just going
Mike
to say.
yeah, that's why Mike and I keep talking about it, saying this looks more like 1999, 2000 than it does um, like 2008. And that's why these rallies don't deter me. Well, it's in the next question. So I'll just wait until you put that up, Mike.
The next question. The next question: if we're headed into a recession, why are the airlines killing it?
You can have a recession with people still traveling, Gary. You'll probably still play golf, you freaking addict. Travel is a different thing because of the pandemic, post-pandemic, and because of work from home. You'll see less travel if work from home starts to completely disappear. I don't think that's going to happen. There's people, and this is part of the reason that I like some of these, like Airbnb type stocks, not them specifically, but oh, that last question. Anyway, that's why some of these stocks look decent to me. They're not really suffering post pandemic as much as they should because this younger generation, which I think it's Gen X, it might be Gen Z, I'm not sure, is the largest generation after the boomers. And they are very into the idea of working 6 months here, 6 months there, and Airbnb all over the place. Travel's got some legs, but if we go into a deep recession, it'll suffer too. But we can have a small recession without travel suffering that much.
What was the next question you were referring
Well,
to?
I was just referencing something that just popped up, but George has a follow up, which I think is kind of important.
Follow up. This was a horrible earnings year, but we're only down 14% as of now. By Q2, are we down more than 14% next year?
I say 38%, but you're forgetting that we were down 26.5%, George. Okay, we're out of earnings now. Earnings ended, and the last batch of earnings kind of started this rally. The rally from being down, well, this is my weekly chart. The rally from being down 26.4% is only 8 weeks long. Okay, so remember, we were down 26%. Now, also, you're talking about from the high close, I assume. So next year, no, we won't be down 38% from the open on January 1st. Okay, we'll be down less than that. But if you go from the high, the total to me is going to be, I mean, I don't even know, Mike, I'll look. If I'm looking for about 3150, that total from the high close will be about 34%. And yeah, that's what I think will happen. Absolutely. But you say we're only down 14%. On the lows, we were down 26. So if we end up down 34, 35% and rally from there, was I wrong or was I right? I don't really care about being wrong or right, despite what Coco will tell you. Um, that's just what I think will happen. And I'm actively in my personal life acting like that's what will happen. Had some calls about it today, as a matter of fact.
Daniel asks, can you guys talk about the delay in rate increases and how long it takes to show up in PE in the market?
So the theory is 12 to 18 months. Okay. The Fed started moving. We forget what the Fed did here. Okay. I actually have this up on another tab, so let me go to it. We forget that, hang on, I want to be accurate here. Okay. No, that's not the one. That's 2015 to 2018. 2015 to 2018, we went from 25 basis points to 225. Okay. And that took 3 years. Okay. 3 years to move 200 basis points. March 17th. Go ahead, Mike.
I have the federal funds rate up here, right here
Mm-hmm.
in the background. I mean, yeah, it took, they started the first hike in
2015.
End of 20, well, you can just really start the liftoff was, 26, beginning of 2016 until 2019. That was the increase from essentially zero to uh, 2,
Two to
2.4.
220. Yeah. So here in this particular one, people forget March 17th, they raised by 25 basis points. May 5th, they raised by 50. And then they proceeded to do 300 basis points of tightening between June and November. Okay. So basically, that's a total of what, Mike? 450 basis points? 400, no, I'm sorry, 425 basis points in less than a year. March, April, May, June, July,
Yeah,
August,
you can
September.
see it right here.
In 9 months. Okay, so can you put that question up again so that I actually address it?
Uh, yeah. how the
Yeah.
delay in rate increases and how long it takes to show up in PE in the market.
So if you go 12 to 18 months, we're not actually in May of 2023 yet when the first rate hike took place, right? So you're talking next year, which is another reason why I think that first and second quarter of next year are not going to be very friendly to stocks, and why I think earnings have to come down. So that I hope that's an answer to the question.
Uh, long U.S. dollar is currently the most crowded trade Bank of America.
Yeah, that's true. I don't know how they gauge it being the most crowded trade. I
It
probably think Long Fidelity's mutual fund is more crowded than that, but that wouldn't be a trade, would it?
it used to be. It's come off a lot in the last few weeks.
Well, there's basically no one that believes the dollar is just screaming short right now. That's probably what they're referring to. I never like when they use that crowded trade thing because it implies that they know the positioning and they don't.
I mean, you can look at commitment of traders stuff and everything else, but that's come off a lot.
Yeah.
Uh, Bob is Bob. There's major talks about Saudi joining the BRICS nations and signing bilateral currency swaps that weakens petrodollar agreement. How do you think that would affect dollar and equities?
I don't think it'll happen. So I don't really worry about it. Um, I mean, this would be really horrible timing for the Saudis to do that. Well, I guess it could happen, but bilateral currency swaps, it's not going to stop basically 90% of the dollars transacting in crude oil. So it could be a little weak for the dollar, but it's really bad economic timing to think about doing that because look at the condition the BRICS are in economically. They're not in very good condition. So the bilateral currency swaps are likely to cost the Saudis a lot of real money. So I suspect that won't happen. I wouldn't worry about it. It's honestly my answer to that.
I got a question for you, Bob.
What's that?
What do you think about the personal savings rate?
We've talked about this a lot.
But now,
Uh,
have you? I mean, look at it now. It's been
credit card
trending
balance.
down, but this is
Look how
getting to
much
the
lower it is
lows
against
in
history.
2008 level.
It is lower than anywhere on that chart. How long does that chart go back? The one you've
This
got up.
goes back to 2004, end of
It's lower
2003.
than any point there. And again, that hurts the lower part of the socioeconomic strata more than the higher part.
Well, let's
It's
let's
almost at
put
all-time lows.
let's put it at. Well, I can't do the whole. Yeah, maybe I can't. There we go.
Yeah, you can just hit max at the top there.
Oh, sorry. You're right. Matt. Yeah, it's set to
It looks
max.
like
So right
at
now we're
all-time
at
lows.
2.3. What was the low? 2.1 in July of '05 was 2. So we're virtually tying the all-time lows.
So that's funny. 2005 was the start of the house flipping craze. So nobody had savings, they had real estate.
And then it was retested back in 2007. We're substantially below the 2007 8 levels. Wow.
Yeah. Right when they could actually earn something on their savings, and we're at record lows,
Yeah.
or near record lows, I should say.
So that's that personal savings rate. That's not long term bullish. No, no.
Sterling is scolding Coco, which I appreciate, but everybody knows if I'm still in the trade, Coco, I still believe it.
Oh, why do
Again,
we? So, all right, Bob. What are your thoughts? Does non-farm payrolls even matter tomorrow? What are your
it does.
thoughts?
No, I think it matters a lot because I think the market is overplaying the shift from Jerome Powell. I talked to two really smart people. I badgered them like Coco badgers me until they would take a 5-minute call from me. And they both basically said the same thing. So one of them said Jerome Powell during Jackson Hole was like Ric Flair. And the real Jerome Powell was yesterday in that speech where he's much more measured and balanced. And she said she actually doesn't believe that the Fed has changed view at all. Just Jerome Powell is acting more like himself. And subsequently, she thinks that especially the yield market overreacted to his speech. The other one was the one who put it in my head that there's only one opportunity that would leave the Fed willing to cut rates, and it's the least likely, which is low inflation and slow economic growth. So, yeah, basically, I don't remember the question, but I think I answered it.
You don't remember, but you think you answered it, huh?
Yeah, I don't remember the question, but I think I answered it.
Oh boy.
What else?
You're
Oh, now I'm fine. So I believe the headline number doesn't matter. Okay, Jerome Powell is now looking for a weakening of the labor market in order to continue with the thesis that inflation can be beat with rates where they are. Because again, if wages continue to rise and the labor market continues to be strong, there will be money buying this slight fall in prices. Look at housing, okay? Housing has started to come down, right? But yet there's still people trying to buy houses because they're paying exorbitant rents right now. If they continue to get raises and continue to get jobs, there's going to be sort of not a false bottom, but a bottom in the housing market that's a little bit lower than maybe people expected, right? That will happen throughout goods, and goods are what's falling right now. Services doesn't fall. Services inflation is permanent. So if jobs don't falter, this is a weird thing where actually, in order for things to be better, you got to hope people lose their jobs. That's a weird feeling, but that's what it is. And that's what Powell is saying, but he can't say it. He calls it the labor market needs to loosen up a little bit.
so you don't think the headline matters to? I mean, they're calling for 3.7.
Yeah, I think the wages matter.
The
I think the
wages.
unemployment rate matters a little less. I think the wages matter, and they want to see that headline number start to go down. But yeah, the rate too. One of the things that Powell said yesterday that I found difficult to believe is that about the 3.5 million worker shortfall in the labor force participation, about 2 million of them is early retirements. I found that a really hard pill to swallow. Um, if you said forced retirements because companies shut down, then I would say, okay, if companies reopen, these people will come out of retirement. But he made it sound like people were just like, you know what? I'm rich enough. I'm just going to stop. I just found that really hard to believe. Really hard to believe.
Business person, thank you for being here. Jay Pound sounded like he lost. He is the Burns from Burns was in the 70s. We need a
Yeah, Burns was
bull.
the 70s. And there's another friend of the show, friend of the podcast named Tim McLean. He actually lives down here in Naples. And that's the first thing he texted me yesterday after the speech. Powell is now Burns. So you're not the only one to think that, business person. I
Does
assume you're
that
non-binary.
mean does that mean we could get a little too dovish too soon and get another rebound in inflation?
So I said to one of the people I spoke to today, I said, I just listened to what he said, and he said they're not going to get off the higher rate too early. And then she pointed out to me, yes, that's true. He said that, but he also said inflation was transitory and then very quickly said it wasn't transitory. So don't think that he can't flip just as quickly about staying on that. So, yeah, if he's Burns, then he'll flip.
All right. Any other thoughts on any market? Oh, any other thoughts on gold? Well, we already
I love
touched on the dollar getting hammered, but gold's on
on
in.
TD Ameritrade today. I said gold is going to 2,800 next year. That's my call. I don't have a trade. Well, I kind of do have a trade on, Mike. If you see here,
Oh, your physical gold.
yeah, but I don't have a trade on. But I think 2,800 next year is going to be the peak for gold.
Well, there we go.
There we have it.
Let's. I did not look at copper today.
I don't think copper had that great a day, did it?
It was, I mean, besides, I should have looked because we had a double bottom in play, but
But
I
it
mean,
reached its target, it looks like.
it virtually nearly reached its target. It didn't hit any alert levels, so I didn't
Yeah,
have any reason to look at it. But
that's
it's
funny.
back. I forgot to look at that. There's a trade in play. Oh well.
Oh, there you go.
Oops.
That's when
Uh,
you know you're comfortable with your work.
it's just like, yeah, if you don't need to monitor, there's enough going on that I can't monitor everything all the time. I mean, I got to watch
Anybody,
every tick in Tesla.
does anybody in here watch, what's the show? Yellowstone?
Is it good?
It's great.
On my streaming service, they were doing one of the channels was doing a Yellowstone catch up, so I DVR'd them all.
Yeah.
So I have all five seasons DVR'd, and I just haven't had a chance to sit down and go through them yet.
It's fantastic. I'm only in season two. We're only in season two. We're watching it here, but Coco threw in here. Bob's like my big brother, very much like Casey and Jamie. If anybody watches that, Coco being Jamie, and yes, that's an insult. So just want to throw that out there for my buddy Coco.
All right, so
All right, guys.
all right. Well, we'll see how non-farm payroll turns out tomorrow,
Yeah.
and
Mike, if you think it's important, text me tomorrow, and I'll come on. If it's just a no-brainer, then I won't be, and I'll be on Tuesday.
but your brains are so important, Bob. Nothing's a no-brainer when it comes to you.
That's because I have no brain. All right.
All
Thanks,
right,
guys.
we'll wrap it
Hey,
up for now.
Sterling, thanks to Sterling as always for moderating the way he does. I appreciate that. He got rid of the porn early, and he almost got rid of Coco, which would have been a joy, but Coco's still here. So what are you going to do?
Oh well, Coco's like the point counterpoint.
Yeah, he is. All right, guys. Cheers,
All right.
everybody.
Okay.
See ya.
All right. All right. Boy, I'm tired. Ugh. So, well, I see some people like Yellowstone, some people don't. I'm going to give it a shot once I have some free time. There's just not enough free time. Uh, but oh man, what now? All right. So we have a minor significant point. When you see, this is a little great thing to add to your notes. When you see a rally like this and then a pullback and virtually this close level, the today closed just below yesterday's, that is a key level to watch for. So over the next few days, this could be a major inflection point. Just something to note, this 40-80 area. 40-80 will just make note of that. You could even make it 40-76 based off the 4-hour chart. So I guess you'll know what level I'll be utilizing. 40-76, little breakdown in the 4-hour rotation zone. Couldn't even get back to the prior key support. Snapback rally. So those are the levels overnight, 40-75, 40-76, and then still this 40-48, 40-50 are my two key levels. To the upside, 4100, you can see here. That's why it's important. You can just get a lot from looking at candle bodies versus the wicks. So you just look at, I mean, bam, bam, with two little wicks above him. So yes, I know this is a close and an open, but it's showing me where, all right, this is a key area, and then you can refine it down at the 1 hour, and you see selling pressure, selling pressure, selling pressure. So just in front of 4100 is the first key area. You get a successful break and retest of that one, or a strong momentum through there. We have 4119. And then I have 4130. 39, and then 41.88. Those are my levels. And you know what Bob's is, 41.50. So a major break tomorrow, because I won't be on until after non-farm payroll. So unless if the market freaks out for some reason and drops below 40.50, which is back at the 200 and the prior breakout area, the key level is just in front of 4,000. So there you have it. NASDAQ still just marching on up. Will be interesting to see how many of these targets we hit before year end. Yes, the double is still in top as a potential. Key support hit by yet today's low, nearly still 11,930. And then below that, we have roughly about 11,800, 11,820. The Dow retesting, closing back above. So it dipped into the support level, hitting the 8 EMA area, and then bouncing back and closing back above the prior resistance becoming support. So this level has held. So that's, again, overnight, 34,365 area, then 34,120 area. The next key target for me is still this 34,783 and then 35,100. Russell, not much news, still the double in place. So that's my key support, still about 1869. Notes, nothing's changed. Back through both the minor harmonic targets and some key level at this 114.10. Next target is 115.03 to finish off this little double bottom play. The potential double top from this morning never triggered, and then it just continued with the move up. So not much to talk about there. The major pullback area now is this 113.25. Dollar index trading at a very critical level. Hit the next key support and harmonic level. This is getting into a very oversold basis, and you see here on the weekly, incredibly oversold against the 50-week EMA and the prior support level from back in May. So I am watching for some key support here. If we start breaking below 103.85, we could quick trip it to 101.95 to 102. So pay attention to that. We've already talked about the VIX. Technically, the double from the little opening thing that never triggered. It confirmed but never triggered on a little spike up into the open and then just selling off. This other double, the bigger double above 22.63 is still technically in play. Crude, we did not close above 21.36, so the double bottom's been confirmed but not triggered. Back closing below the rotation zone. So on a break above this 90 or 82.36 area again, it could be an intraday play and only rolled into a bigger long play if that level does close above it. Other than that, it's just trailing a stop now from the percent B buy. We looked at gold already. Gold, now your key support coming back at 1,800 on any pullback. If that starts breaking, it's back to 1783, and then we have a potential gap fill. That's about it. That is about it. Beverly Hillbillies, we're going way back then. Welcome Back, Kotter. Could you imagine them trying to put on a show like Welcome Back, Kotter in this day and age? Could you imagine? That would be funny. I liked the first couple seasons of 24. That was a fun show. The Munsters, now there you go. Nat gas held 640. What, you want to talk the market still? I'm marketed out. Nat gas. Yes, this is so far a really orderly pullback with getting daily cycles to the bottom. It can still have a little more of a pullback, but I am starting to strongly watch for a rotation move up. And by the way, if on a close above today's high, it's not only a rotation buy entry, it's a percent B buy entry. So do keep that in mind if you're looking for anything short term in natty gas. Can you imagine All in the Family or the Jeffersons? Man, let's bring back the 70s TV sitcoms. Let's make people's heads explode. Wouldn't that be something? I'm surprised even the reruns haven't all been canceled. Jeez. Yeah, it's Trigger 'em all. Sanford and Son, yep, that would drive people. Oh boy. People's heads would explode. I mean, come on. What if we had like we should just have, that would be a great streaming channel. 24 hours a day of the classic 70s politically incorrect sitcoms at this point. Wouldn't that be fantastic? You could tune in at any point in the day, and within like 10 minutes, something that would not be acceptable to this day would be said. And that could happen 24 hours a day. Fantastic. Boy, I'd have to give up the markets. I'd just sit, you just put me in front of the TV all day, and I'd be a happy camper. Hey, Dr. M. 4-hour double top on NQ. Which time frame? Remember this? Yes. The bigger time frame, yeah, but that's a long way off for potentially triggering. Oh, you said 4-hour. This is not. This is not a double top. Nope. Not a double top. Does not fit. Really, the key thing you're watching for with this spike low, I'd even go a little lower, but you break down below 11,933, you're into the clear path move from the Powell speaky. So I'd be using the clear path targets. But there is no technical double top. Isn't that Nick at Night? I don't watch Nick at Night. See, I've come up with another fantastic idea. And who did I remind of their football coach? And Balaji, are you still here? Balaji, I didn't see that comment. VAXX. I have never traded VAXX. Ugh. Looking for long setups? Who's going to know what I have to say on this thing? Oh. If you're still here, let me know. Otherwise, I won't waste my time. The only key thing is as long as you don't break this 227 area, holding somewhere in 227 with a stop below 194 is about it for a bounce play. Other than that, I hate moves like this. I mean, look at the last, if you want, what is this? Health technology. Oh, it's a biotech. Would I be looking for a long play? Really, no. I mean, isn't this nature of the par for the course? Major run up, collapse, run up, collapse, run up, collapse. Not saying anything here, but run up, collapse. So if I was going to play something, it would be with a very tight stop. against you. You have your 62.5 and your breakout area. Other than that, this would be for a quick bounce. This is, I mean, even on, yeah, you can't make long-term conclusions from short-term charts. However, this doesn't have a lot of history, and what I'm seeing is a lot of the same pattern. So I would not be chasing this thing. Did you miss the SPY? Oh, so there you go, Balaji. Again, I know nothing about this company, but from pure price action, whew. I mean, this is why I like to find things that I hate these kind of explosive moves, reversals. They are too tough. And they're not consistent. Well, this is consistently sucks people in and then cashes them out. On the spiders, I did not go over the spiders. The key supports coming in at 404 roughly, and then 402.50. Actually, don't. Well, no. No. So that's your key. The next key target area, we didn't quite hit it today, is still this 410.83. But on any pullback, the 200 is key, and then this breakout area. Otherwise, the targets, the upside remain the same. Let's see. How do I think this quarter ends on the S&P? I still think it will be an up quarter. I'm got to keep going from the long side. That doesn't mean we can't get pullbacks. I got to keep going to the long side unless there's a more key trigger at more bearish trigger. At this point, we are nearing. I forgot to mention this too, so thank you for reminding me. We could be nearing some pretty significant Tom DeMark exhaustion patterns. Okay? DeMark sell setups. So I am paying attention to those, which could be exhaustion patterns, which could start leading to more of a pullback. However, and I'm going to say, however, key, there is a lot of support in here. There is a lot of support to burn through. So even on pullback trades, I can't get hyper aggressively short unless something underlying changes. Especially since we still have upside probabilities. So do I think the quarter? I think this quarter will still close. Well, the quarter, I think, let's see. We're roughly the quarter will close up. Unless there's a out of the blue event, this quarter will close up. I mean, I'm talking an out of the blue event that, like a black swan event that catches the market completely off guard. This quarter will be up. Oh boy, everybody. Can you go through gold? I went through gold. What else did you need with gold? Gold to me is still a trade around a core position. It's just letting stuff run. The only area I would start getting cautious if it loses the 200 and then about 1792, we could get a profit-taking pullback. However, that would take this is going to trade with inversely to the dollar. So if the dollar keeps breaking down, you can see gold go substantially higher. If we find a floor, at least a short-term floor in the dollar, watch for a pullback in gold. The major key support is back at 1740. You do not want to lose 1740 at this point on a closing basis. Other than that, the targets are higher. Here's a great way to utilize once it's through this 1828 target. This is a great little area to use your harmonics from the reverse side. This is why I love this area, because yes, we have price action, but look what the harmonic reinforces. So on a continued level, I'd be using 1850 as the next target, the next minor target, and 1876 as we got our harmonics up there. And look, what's up here? Key resistance up in that area. Reinforced by a harmonic. And that's a reverse harmonic. So now you have two great areas to take profits, move stops, combination of both. Cycles are not yet at the top for the daily, so I will be watching for a rollover move at some point, but we're not yet rolling over. And on the weekly, we are at the top, and we are entering overbought conditions. So from a trailing stop perspective, this is a good area to tighten up a trailing stop. This is a bad area to initiate new longs. The new long initiations, okay, were on the breakout move or the pullback move, and we had a rotation buy in here and a percent B buy in here. So that this was the buy area down here. Breakout, back in the rotation zone, retesting key resistance, becoming support, trying to dip down, closing back up, and then the follow-through breakout move. This would not be an area I would be initiating new longs. We're sitting up against key resistance. Does that mean it has to stop? No, but I'd be aggressively trailing a stop here from trading around a core position. If you're in gold for a certain super long term, I would not crowd a stop. If you're in it for a short term and then waiting for a pullback, I would keep a tighter rather than looser stop. Again, trade duration is very important to know, because there are people who trade gold, and if you're trading around a core position, you're going to keep a core position always on, and then, as I like to do on rallies and overbought with topping patterns, unwind some of it, and on pullbacks to key levels and with percent B or rotation entries, you get to re-add it back on. So that way you're not never worried about missing a move, but you're also harvesting, essentially harvesting yield in gold. Now, at some point, gold is going to make, I still think gold will make a major breakout play. And then it's just not harvest, it's hold. Thanks. Friend of mine said this company is due for some good news and sought one up today, so thought of picking your brain. It already did its launch move. You know, I don't have anything else to say. Do I think we reached 46.39 by the end of the year? If you had to have me make a 43.69, no, I'd be targeting between if we continue to rally even after the pullback, my next target is 42.24 area. That would at least take it to the 87.5. This is my key line in the sand. Why? Because a close above there shifts longer term probabilities. See ya, George. I have no idea. That's a good question. Then I got to wrap this up. This is, can you, yeah, I mean, this is the only thing, and I don't have it on the chart on this platform, but hopefully other people notice this. This was the only trade. I hope you noticed it, which the doubles, even from the aggressive targets, was a dead stop right there. If you're looking for still continued bullish follow through, the next target I would be utilizing is the next two targets if you're trying to keep this for more. And if you're playing something like this is always where I don't mind taking something against the key moving average off the table. And then if you're going to try to play for a little more, you have two gap magnets to the upside. 806 and 834. And why? Because we don't have a super strong topping pattern. This is a minor topping pattern, which was a, I mean, you could still watch this key low right about here, right about 776. I'd use 775. You start getting pullback below there, it's probably put in a short-term top. But that's your plays. If you're trying to play for more, you have two gap magnets overhead after the double bottom. Yeah, see, we don't want to clean them up. That's they couldn't even play it. Disney and Netflix, my thoughts. These will both be shorts again at some point. Look at the PE of Disney. Yeah, it's bullish that, you know, they flipped the CEO and everything else. Long term, especially next year with more consumer rollover, these are both short candidates for me again. Especially Disney, but it's not a key short yet. Now, in the short term, we break below about 93.85. It's a short term breakdown play. But not long term yet. Long term, we'll have to cover, we will have to cover Netflix tomorrow. I'm running out of energy. But long term, you still have a potential double bottom in play. But look at what that's going to do to the PE should that trigger. We're already trading at a PE of 56. You got this stock is priced beyond perfection. Even, you know, with theme parks and everything else that goes on with Disney and the streaming and new CEO, it's no. This is not something I'd be chasing higher. If anything, if there's any short-term setups, it's still playable. But from a long term, not yet. Netflix is still in, you had the double that never triggered and is a triple. Hitting that 319 harmonic on a continued up move. You still have the gap. You still have the gap fill. The next key target is, so this is still tradable from the long side. Next key target is 332 roughly. And then the full gap fill, which is to 348. So is there any short setup? No, there's a potential short setup that never triggered, which is now well off the table. So it would just be trailing longs, or it would be a very short-term breakout play. I mean, if I had to choose between the two, I'd be playing more to the upside of Netflix. However, Netflix will be a rollover play at some point again. I'd really like to see a topping pattern up here somewhere. All right. That's where we sit. Zscaler. I looked at that earlier and I saw it gap down. They had earnings today. So they beat, but down. Is this just going to be another one that gets bought tomorrow, or bought or pre-market for the gap fill? Because that's what we're in. All right. I keep saying I'm done, and now I'm really done. ARC pretty much nearly completed the double. I'll just leave it at that. The market we're in. Mike has left the building. Mike is not officially here anymore. With that, I will be back bullish or bearish for tomorrow. You know, boy, am I bullish or bearish for tomorrow? Based off where we are, I'd have to be more positioned. Today is just trailing longs at this point. It's because there's no great topping pattern. So I hate that question because I'm sort of neither. I'm prepared for a reversal play, but there's no strong top pattern in place yet. So if we start breaking below today's low, it would be a short-term, very quick short, not an extended short. But based off of this, it's just trailing from the long side. That's who said, I look like your football coach? Coach Mike. You're very welcome, Ted. Smack the like on the way out. I agree. All right. So there's your dream come true. Can we not have a binary option? Trailing from the long side, we break today's lows, quick shorts. That's how I'm looking at it. With that, I will talk to everyone later. Bye for now.